Buying call options. This segment focuses on the information you need to place one of the simplest option trades possible, buying and selling call options. If you have experience identifying bullish stocks and taking advantage of upward trends, using call options will be an easy, natural step for you to take. Call options trading does involve a few additional considerations you must account for, however, which we will outline in detail. Buying a call option is a bullish trade in the same way that buying a stock is a bullish investment. However, there are differences between the two trades that you have to be aware of. Some traders prefer to focus on stock trading. Others only use options, while others will incorporate a mix of options trading and stock investing into their overall investing strategy. Buying shares of a stock gives you an ownership stake in that company. It gives you the ability to sit at shareholder meetings and vote on corporate initiatives and governance. It also entitles you to a share of all dividends paid by management. Buying an option gives you control of 100 shares of the stock, but does not give you access to any of the items just mentioned. Dividends are not paid to option holders, nor are they included in shareholder meetings. That said, there are clear advantages to buying call options rather than purchasing the stock outright. Buying shares of a stock often means committing a significant portion of your capital to that investment. For example, if you want to buy 100 shares of a stock priced at $25 per share, you have to spend $2,500. Buying a call option involves a much smaller capital outlay. A call on the same $25 stock, for example, might only cost you $4 per share, requiring only $400 instead of $2,500. You have the same control of 100 shares, but for a fraction of the price. Options also give you a greater level of liquidity than most stocks. Daily options trading volume is higher than the volume of the stock market, meaning that buyers and sellers are able to place option trades and have them filled very quickly and efficiently. This gives you ready access to your money if and when you need it. Call options also give you a higher level of flexibility in your trading. When you buy a stock, you can try to dictate the price you pay for the stock by using limit orders, but you run a real chance the stock may move past your order and leave you behind. Using a call option allows you to rent the stock for a short period of time to see if the stock makes the move you want. Since exercising the option means paying the strike price of the call, you have better control of the price you end up paying for the stock. Keep in mind also that it isn't a given that you will exercise. If the stock goes up the way you want, your call option will increase in value in similar fashion. You have the choice of simply selling the option back to the market and locking in that profit. Although most traders think of call options in a very short-term context, it is possible to purchase call options with expirations ranging from just a few weeks to upwards of 2 years or more. This gives you the ability to buy a call option for any type of bullish move you anticipate. Whether you want to ride a new upward trend for as long as possible or simply take advantage of short-term swings in price, you will find option contracts that fit your strategy. Also, because of the lower cost associated with options, your percentage return on the money you invest will be much higher on winning trades than if you bought the stock outright. Earlier, we discussed the fact that seeing a stock making a bullish move can present the same opportunity for a call option trade as for buying the stock. In very literal terms, this is a true statement. Anytime a stock breaks resistance, bounces off support, or swings from a higher low to a higher high along a trend, option traders use the same signals to enter a trade as stock buyers. We can easily see that Apple Computer has provided abundant signals in the past year. both at the beginning of new upward trends as well as during the continuation of those trends. Ultimately, option traders rely on the same principles of technical analysis to buy calls as stock traders do to buy stock. Identify trends and use support and resistance levels to identify buying and selling points. Once you have found a stock that fits your technical analysis for a good bullish trade, there are elements that are specific to the call option itself that you need to think about before entering a trade. The steps outlined here and in the next slide will help you make sure all of your bases are covered. Whenever you analyze a stock's price movement, you should be able to come away with 3 specific price points: a price at which you would be ready to buy the stock, a target price where you might take profits, and a stop-loss price to get out of the trade if the stock moves against you to limit your losses. With call options, you apply the same discipline. In fact, rather than identifying option prices for entry, target, and stop losses, your option trades will be more effective when you base each price level on the underlying stock's movement and buy your call when the stock meets those criteria. Once you have your entry criteria set, you will need to think about how much time you will need for the stock to make the move you want. Remember that options are extremely time sensitive. Perhaps the most common trading sin committed by option traders is not buying enough time. As you go through your analysis of the underlying stock, make sure that you identify not only how far the stock might move from your entry point before its next resistance level, but also how much time is typically required by the stock to make a move of that size. Suppose that you want to buy a call option on a stock that is bouncing off of support with resistance $5 away. If the stock typically takes 2 weeks to move between support and resistance levels, an aggressive trader will usually buy a call option with a 6-week to 2-month expiration period. More conservative traders will usually buy more time, ranging from 3 to 4 months away in order to minimize time risk. After identifying how much time you should buy, the next step will be to determine what strike price you will use for your call trade. As discussed in previous training segments, whether you buy in the money or out of the money options will greatly dictate the aggressive or conservative nature of your trade. Remember that the deeper in the money you go, the more conservative you are. In return for a high degree of equity, you also must pay more. At the same time, going for a lower cost by going with out-of-the-money options will make your trade very aggressive and increase the chances of losing money. You need to identify a relative middle ground where your opportunity and odds of success are acceptable to you. As a general guideline, it is a good idea to buy at least 2 strike prices in the money if you want to be conservative, while a more aggressive trader may use the first in-the-money strike price, or possibly even the at-the-money strike price if it isn't in the money. Beyond the at-the-money strike, however, you are usually taking far more risk than you have opportunity for profit, so purchasing further out of the money is not advisable. Before you actually buy your option, you need to make sure to think about how you will get out of the trade. This rule applies to both a profitable and losing result. Remember that under the best possible circumstances, there is no more than a 50% chance the stock will move the way you want. You need to have a plan for how you will handle your trade, no matter what it does. One of the ways that buying call options differs from stock buying is in the fact that options have a fixed lifespan, where stocks do not. The general attitude that many stock traders use, especially when the stock appears set to begin a new trend, is to ride the trend for as long as possible and maximize profits. When you buy a call option expecting the stock to move a few dollars in a short period of time, it isn't advisable to hold on to the call option for as long as you can. If the stock hits the target price you set when you performed your technical analysis, sell the call back to the market and take your profit. This cut and run approach may sound contrary to the axiom used by many traders, let your winners run. Remember that the time-sensitive nature of your call option means that time is against you. The longer you hold on to the call, the more time decay can erode any profits you may have. This is why successful call option buyers are quick to take profits and move on to another trade. The only exception to this rule is if you see a new trend developing and specifically buy enough time on your call option to allow the stock to move along the trend. Leaps options are long-term option contracts that for many stocks extend anywhere from 6 months to 2 years or possibly longer. If your intent is to maximize a trend, look for a leaps option that exceeds the amount of time you think the trend might last. This is the only way to maximize profits on long-term stock moves. Besides identifying a target price to take profit, you must also plan for the eventuality that you read the stock wrong. Even the best traders in the market are only right about the direction a stock will make 30 to 40% of the time. The high occurrence of losing trades makes it absolutely critical to take the time necessary to plan a stop-loss point for your trade in the same manner you would for a stock trade. Identify the closest support level for the stock relative to its current price. Plan to exit your option trade if the stock drops below this price level. If your broker provides the ability to place contingent or conditional stop-loss orders, you can set these rules on your broker's trading interface. Identifying entry, target, and stop-loss prices on the stock will give you an idea of what your opportunity is versus the potential risk in the trade. Translating those numbers so they apply to the call option you are thinking about is a simple matter of integrating delta into your analysis. Let's walk through an example to demonstrate how it works. Suppose that you have a signal to buy Apple Computer for $190 per share. Analyzing support and resistance levels gives you a target price of $195 with a stop loss of $188. After examining the options that are available to you, you decide to buy a December call option with a strike price of $190. Your cost for the option is $10.20 per share, or $1,020. You check your delta values and find that your call option carries a delta of 0.54 or 54 cents for every $1 change in Apple's price. Since you have a $5 profit opportunity, multiplying the delta of 0.54 by $5 gives you a potential increase of $2.70 per share in the option if the stock moves quickly to the target price. Dividing the potential gain by the cost of the option means that you have an opportunity to make over 26% return on your investment in a short period of time. With a $2 potential drop in the stock before you would exit the trade, you can forecast the change in the option's price by again multiplying the $2 loss by the 54-cent delta. The option would probably lose about $1.08 in value if the stock drops far enough to stop you out, which would result in a loss of a little over 10% on the money invested. Reasonable considering that your opportunity is more than twice as high. Taking the extra step of integrating delta into your analysis will make it easier to manage your emotions and the trade effectively no matter what happens.